Howdy, Jacob here. Today we're looking at MDC Holdings. So first thing, 3.76% dividend yield, $4.2 billion market cap, $3.9 billion enterprise value. So net debt, more cash on hand. They have not had a negative revenue year in the last 10 years. That's interesting to see. They're in the household durables industry. So 714 in cash, 561 million in short-term investments. So we're looking at about 1.3, little under 1.3 billion, and then long-term debt 1.4 billion. That's good to see. Healthy balance sheet. Interesting cash flow. Their earnings have been great. So we can see 2014, 63 million, and I mean, really just almost went up from there. Now we're looking at 560 million in net income. But if we look at a 5-year average on free cash flow, we can see that it was actually negative in 2018, negative in 2020, and negative in 2021, with a 33 million positive free cash flow in 2019 and an 800, almost 80 million in 2022. With year to date, we're looking at over $1 billion in free cash flow. Interesting. Okay, so that's not too much from stock-based compensation. Looks like just a lot of change in working capital. The inventories are humongous. What do they do with cash flow? So they actually made some devastations from 2014 to 2020, essentially. Made a big acquisition in 2022, but they didn't go into debt or anything for it because they produced a lot of cash flow. Um, Interesting. This is weird. So 150 million payout. I mean, even including the negatives, the 5-year average is still probably over 200. So it's a good amount, but it's really just whether they can keep this immensely high free cash flow or whether they'll go back to the negative producing free cash flow from before. Um, Margins, gross margin was 18 over here, and now we're looking at low 20s. Operating margin, dang, 6% up to 13%. So it looks like something happened post COVID to where their margins are just fantastic. I don't know if this is something like um, logistics where their margins and revenue just exploded like crazy from COVID and might be dampened down, but uh, maybe it's something similar. So they're a subsidiary engaged in the home building and financial service business. Oh, no duh. That's crazy. Okay. So the home building industry went absolutely bonkers post COVID, so it makes sense. Um, I wonder why in 2021, though, they didn't produce free cash flow. That's interesting. Um, Free cash flow, I don't like the free cash flow so volatile, but I think that 2.1, $2.10, probably fine just staying with that because, again, their cash flows have just been so wonky. I mean, I could say that like in comparison to earnings per share, it's well below 50% payout. Like we're looking at almost, well, really like 30% payout, and they don't make too many acquisitions, so their use of cash flow is mostly to dividend and maybe buying back a little bit of debt. But um, I mean, they got a healthy balance sheet. Maybe I'll say that they increased their dividend 3%. I'll give them a little bit of jump there because they do have a lot of cash on hand, even with their cash flows negative for a little bit or cyclical as it is. They can use some of their cash on hand and still provide a safe balance sheet. As for revenue growth, I mean, yeah, we've seen a lot of growth here, but I'm probably going to slow it down a bit to say that maybe the housing market might slow down for a little bit. Definitely not. I'm not going to assume some crazy macro, but just to be conservative, I'll say that maybe they have 3% growth, 13 PE, price free cash flow, saying at the end of 7 years, they still have a little bit of growth ahead of them, but nothing too much greater than inflation as they don't make too many acquisitions. And then for margins, I don't like that their earnings have been consistently higher, so that's not higher than their free cash flow. But again, most recently, free cash flow margin have just been absolutely crazy. It's just whether they can hold that or not. I won't know. I don't know until I dig deeper, and even then, I might not know it, but I'll have a better idea. I think I'm still going to go with an average margin here, so maybe 8%, 4%. Increase shares about 2%. And yeah, I'd say it's going to have to fall quite a bit. Company's stock price would have to fall 53% to get us to a 50% return. Given these assumptions, I'm pretty fine with these assumptions. I think that the odds of them holding the margins as high as they are right now is a little questionable. But I mean, if you know more about the business, good for you. That should help you in your estimation. But for me, being conservative and not knowing too much about the business, just knowing about the industry as a whole right now, I think I'm comfortable just waiting on this for a bit. So thank you, and I hope you have a good rest of your day.